So good morning, everybody, and welcome to the quarterly Bulletin briefing. For those who don't know me, I'm Jill Ford, the Head of Communications at the Central Bank. I look forward to meeting any of you who I don't know already. To my right, Luca Onorante, who's the Acting Head of Monetary Policy. He'll open with a presentation on the international environment. John Flynn, Head of Economic Analysis, will then give an update on the domestic Irish economy. And then finally, Gabriel Fagan, our Chief Economist, will present the key messages, policy messages, and John will highlight articles in the Bulletin. I hand over now to Luca.
Shall I start? Okay. Good morning to everyone. I will start with a few words on the international developments, because these are, in this particular round, quite important to set the stage for what we're going to say about the euro area. So the first important thing to notice is that the global GDP growth is actually ongoing. It's at a moderate level and it's somehow uneven. It's mainly driven by the recovery going on in advanced economies. There is kind of a decoupling here. This is the main message. On the one hand, most advanced economies outside the euro area, in particular the United States, have been recovering in the course of the year, and they're actually expected to strengthen a bit further. This is supported by several factors, mainly by internal consumption, by the effect of low oil prices, which has, in the United States in particular, a positive effect on its disposable income again, and the effect, of course, of continuing favorable financing conditions. I would like to add to that there is a continuing strengthening, especially in the US, in the housing market and in labor markets, and that also has a favorable effect on private consumption. On the other hand, not all, but some of the market economies, some of the emerging market economies have shown some signs of a slowdown. In particular, all the eyes seems to be looking at China at the moment. The outlook of China has become during the summer more uncertain. There have been several events. Fall in the stock market of about 40%, devaluation of the currency, and definitely lower growth than it was previously expected. And all this has increased volatility and decreases growth expectations. If you take these two things together, we can have a global scenario in which the risks to the global outlook are on the downside. On the one side, there is the unfavorable impact on global demand of the slower growth of emerging markets. On the other side, economies like the United States, and in particular in the United States, there are growing expectations that financing conditions may become tighter. And these two effects set a bit the stage for what I will tell on the euro area development. We are there already. Let me start with growth. Economic recovery is continuing at a moderate pace and somewhat slower than previously expected. GDP in the second quarter, quarter on quarter, has been growing 0.3%, which is about 0.2 less than it was previously expected. So the numbers are not extremely positive. The recent data, when look at the national level, pointed some differences. So this growth is not completely even. There are cases like Spain, which has a relatively high growth in recent data of about 1%, and countries like Germany, Italy, and France, which are lagging a bit behind. When we look at the components and the determinants of this growth, we see that there are some positive contributions, mainly from internal factors. There are positive labor market developments, and this favors internal demand. There are ongoing favorable monetary policy conditions and financing conditions. And of course, there is the favorable effect of the continuing low oil prices. Looking ahead, the sentiment indicators such as PMI and others see in the short run an ongoing trend, positive but moderate. When we move to prices, HICP inflation has been apparently stabilizing in the last month at very low levels, but somewhat above zero. The effect of the more volatile components, those that actually drive up and down the HICP, which are energy on one side and food prices, unprocessed and processed on the other, seems to broadly offset each other at the moment. When we look at the data, we see that inflation has been, overall inflation has been at 0.2% in August, which was the same number as June and July. And if we take away the energy component from inflation, we see that inflation has settled at 1.1 in August, slightly up from a 0.9 in June and July. I've just been looking at the new Eurostat flash estimate for September. It's actually minus 0.1. So the evidence is still a bit mixed. We have to say that HICP has also been slightly lower than it was previously expected. This mainly reflects the lower than expected scenario for economic activity and the pass-through of oil prices. Oil prices tend to pass very, very quickly into the energy component of HICP. But the energy component of HICP is about 10% of the total. The remaining 90% has a pass-through which is lower, and we think this pass-through is still ongoing, and that keeps prices relatively low. On monetary policy remains accommodating, and helped by the ECB monetary policy, including quantitative easing, we think credit and financing conditions remain overall favorable. We see an improvement in credit supply conditions. And to some extent, we have seen turnarounds in financial markets and housing markets with national differences. Ireland is a good example of housing market. Now I come to the risk to projections. The risk to projection have to be seen against the background of the first slide, the one of global development. The growth projections are overall subject to downward risk. This is related to two main factors, the one I explained before. On the one hand, there is uncertainty about the economic situation in China and in other emerging economies, and this reduces global demand and global trade. This could reduce. On the other hand, there are rising expectations of a move of the Fed at some point in time. If you look at expectations, the question is more when than if at this point. And this, of course, would tighten financial conditions. In particular, tightening financial conditions have a further impact, especially in emerging economies. Therefore, the risk is of a spiral of higher interest rates and lower growth. When we look at inflation, the story is relatively similar. We have, on the one hand, lower than expected growth, and then we have the second round effects from low oil prices and the effect, of course, of the exchange rate. Lower reward demand could be a further factor of risk. At this point, you had a lot of words. I want to show you at least two charts. Here we are. On the left side, you have euro area inflation, year-on-year percentage change. On the right-hand side, you have a chart on GDP growth, quarter-on-quarter change. On the left side, the chart on the left side will show you headline inflation, including the Eurostat flash estimate for September, which is negative. In the last press conference, Gillian Phelan received one of the questions, are we at the trough? Is there a turnaround in inflation? The answer now as then is that it's a bit early days in order to give a final answer. What we see is that headline inflation seems to be going up and down, following food and energy components mainly. But if we look at HICP excluding energy and unprocessed food, which is the part which is more volatile and internationally traded, we see that there is some evidence of a stabilization beyond a trough at a low level but positive level. If we go to the growth side, growth seems to be consolidating at low values. This is a quarter-on-quarter chart, and it actually shows that this is the 9th quarter in a row of albeit low, positive growth. So let's say the consolidation of the economic activity seems to be ongoing for some time now. Finally, all the numbers you have been waiting for. Here I don't want to go into all single numbers. These are a set of projections from the OECD, the most recent available for GDP growth and for inflation. On the GDP growth, the story is the one I said before, is decoupling basically. If you take a look in 2015, GDP growth, United States, Euro area and Japan seems to be progressing in the path of growth. United Kingdom is a bit in between, but they start from very high level, so a bit of slowdown is not a big factor. On the other hand, if you look at the global figure shows a slowdown. And this slowdown is particularly evident in China, in which the forecast is about a slowing trend of growth. Turning to inflation, let me just say that the latest MPE, monetary macroeconomic projection exercise, has given projections of 1.4 GDP growth for 2015 for the euro area, 1.7 in 2016, and 1.8 further on. Turning to inflation, the general message, with the exception again of China, which is a story in itself, is low inflation, not only in the euro area, but pretty much around the world, at least about, more advanced economies. When we look at the MP numbers, in 2015 we have 0.1 projection, 1.1 for 2016, and 1.7 for 2017 and onwards. And now I think you all want to know what happens to the Irish economy, so I just pass the ball to Jonathan.
That's great. Thanks, Luca. Thanks for that. Just to start with, to give you a look at our latest projections. To start with, I suppose, the data that we have for the year to date, tell us really that the recovery has matured and has now moved well beyond what was the initial export-led recovery or export-driven recovery in growth that we saw in recent years. National accounts data for the first half of the year indicate that the growth of the economy has broadened and has accelerated, and that the main impetus, significantly, it's also telling us that the main impetus to that growth is coming from domestic demand, and that domestic demand is playing an increasingly prominent role. We've seen strong growth in employment, and that growth in employment has helped consumer spending and growth to pick up. So the pace at which consumer spending is growing has now accelerated. And on investment, while there are some issues that have to be allowed for, so for example, say while aircraft purchases and R&D investment related to patent purchases don't necessarily add much to domestic demand, if we look at underlying investment net of these things, we see that investment too is also growing fairly strongly. Now, why has growth broadened and accelerated? Why has it picked up to the extent that it has? And in effect, what we've seen is the coming together of a number of different factors, a broad number of factors, and essentially all of them are pretty much growth supportive at the moment. So they're all tending to add to sort of the strength of activity in the economy. One of the things that's striking about the recovery in activity so far is that it has been fairly employment rich. So if we look over the past 2 years, for example, there's been growth in employment of about 90,000, and in net terms, that has almost exclusively been growth in full-time employment. So it's been a lot of jobs created and a lot of full-time jobs created, and that has tended to boost incomes and in turn has tended to boost spending. Separately, if you look at the policy environment is less constrained than it has been in the past. We've seen a gradual easing in fiscal consolidation as the targets and the achievement of the targets comes into view. And also, on top of that, financial conditions have been favourable for the sorts of reasons that Luca has been talking about. And again, both of those things have had fairly positive effects on incomes and on confidence and on consumption. Obviously, lower energy prices have also been a boost, given a boost to purchasing power. And again, that has been a positive. And then separately, in addition, there's a sort of a set of things you could look at as a kind of a gradual easing of the legacies of the crisis. And those legacies largely involving debt. Now, it's not that indebtedness has gone away, far from it, but that there's been some improvement in household and firm balance sheets. And although debt levels do remain very, very high and still need to come down, the extent to which they're easing back and they're not holding back spending as much as they have been maybe in the past. Separately, Ireland trades with a diverse set of trading partners, and demand has remained pretty solid in some of those trading partners. So if we look at the US and the UK, so in some key export markets, demand has remained fairly solid, and also to a lesser extent, but it's been a factor. Exchange rate depreciation has also helped for some sectors as well. So it's been the coming together of those factors which has helped to sort of drive up the growth rate in the economy and helped it to also to broaden out. And as I say, many of them have kind of lent support to domestic demand and to the strengthening of domestic demand. Now, if we just look at the numbers there, the national accounts data that we have for the first 2 quarters of 2015 has been exceptionally strong. So on average, the economy grew, GDP grew by 2% per quarter in the first half of the year. Our last published forecasts, which we published in July, were based on the Q4 national accounts. So we didn't have these data. The Q1 national accounts were published at the very end of July, I think on the 31st. And the Q2 national accounts we just got a couple of weeks ago. And so when we take this data into account, just taking it into account, it's going to push up our GDP forecast for 2015 significantly. So for 2015, our latest forecast is for GDP to grow by 5.8%, which is basically 1.75% higher than our previous published forecast. And most of this is being driven by the strength of reported data for the first half of the year. Now, while that is the case, the outlook also has become more favourable, and it's primarily this factor which was responsible particularly the prospect of a further strengthening of domestic demand relative to where we saw things a couple of months back, which is responsible for the upward revision to the growth projection for 2016, because we now expect GDP to grow in 2016 by 4.7%, which is about 0.5% higher than we did at the time of the last Bulletin forecast. If we look at some of the components to see kind of what is driving that, basically in terms of consumption over the remainder of this year and next year, kind of what we see is that further increases in employment, increases in disposable incomes, and gradually improving and stabilising confidence, consumer confidence, supports a pick-up in the growth of consumer spending. So our forecast for consumer spending growth this year is for growth of 3%, which is 0.7% higher than our number last time. If we look at investment, as I said, in terms of looking at investment, it's useful maybe to abstract from the volatile kind of aircraft purchases and R&D components. And if we do that, even underlying investment on that basis is forecast to strengthen pretty considerably this year as well. And that's going to tend to take the investment share of GDP back towards what would be its more long-run average, because we've seen the investment share, we saw the investment share fall pretty significantly during the bad years. It's been on the way back, and I suppose our forecast is that it will continue that way over this year and next. Now, I suppose a point to make about investment is that there is a lot of uncertainty around the forecast, because the aircraft purchases and the investments in R&D, which is essentially investment in patents, is volatile, and the timing of those flows in relation to that is volatile. So it brings some uncertainty to the investment forecast. Now, it doesn't affect the overall GDP number, because there's an offsetting increase in imports related to that investment, so related to the purchase of the aircraft and related to the patents. So investment goes up, imports go up, net effect on GDP, it tends to wash out. But what it does do is it has an impact on, if you looked at a simple measure of domestic demand, so you just need to be aware of that when looking at domestic demand. If we look at exports then, we've also raised our forecast for exports, as you can see from that. And that's largely as a result of the strong growth in exports that we saw in the first half of the year, which was concentrated mainly in pharmaceuticals and chemicals. So we've pushed up our forecast for 2015 significantly, but the imports forecast has also gone up, so the net contribution hasn't shifted a whole lot. Looking ahead, kind of our assumption is that the issue of contract manufacturing complicates the task of forecasting, but our assumption is that exports will return to growing broadly in line with demand in trading partner countries. There will be some carryover into 2016, which will keep the annual growth rate of exports high, but gradually we see it kind of returning back down. But basically, the main driver of growth through this year and into next year remains domestic demand rather than net exports. If we look at inflation then, while the recovery has broadened and gained momentum, there hasn't been much upward movement in inflation. Overall inflation has remained relatively subdued, and basically what's happened is that the lagged impact of softer oil prices has offset some increase in services price inflation. Oil prices are expected to remain broadly flat next year. Services price inflation is still to run at over 3%. So net, that will tend to push the headline rate up, but we forecast a headline rate of inflation of only 1.5% next year. So essentially inflation still remains relatively subdued. The balance of risks in the forecast we see as being broadly balanced because on the domestic side there are probably some upside risks to these numbers. On the external side, for the reasons that Luca talked about, there may be some downside risks, but net, we probably see overall things as being balanced. Finally, I'll just say a little bit about the labour market and our labour market numbers, because the recovery in the labour market and the growth in employment has been one of the major positives for the economy in recent years. It's been ongoing for several years now, and the pace of improvement in employment has probably picked up over the past year. Employment has grown by 3% over the past year. If we look at it, say, since the trough in 2012, it's up 7% since the lowest level reached then. And if we look at the unemployment rate, it's fallen by about 1.5% over the past year to kind of below 9%. Encouragingly, employment growth has broadened out and is pretty broadly based across the private sector now. The other notable feature has been that employment growth, as I said earlier, is concentrated mainly in full-time employment. So if we look at it, full-time employment has over the past 12 months has grown at a rate of 4%, which is pretty positive. If we look ahead with the current trends of the economy relatively favourable, and particularly with the outlook for more job-intensive growth in domestic demand, we see kind of the current rates of employment growth kind of broadly being maintained. So we forecast employment growth essentially to average about 2.3% annually this year and next year, and that should tend to continue to push the unemployment rate down. So we see that continuing to fall. So that's the overall kind of view of the forecast. I'll pass back to Gabriel now to talk about some policy issues.
Thank you very much, John. So basically, in this round, our policy messages are mainly concentrated on the fiscal side. But before getting into the detail of that, I think it's just useful to set the context. What we've been seeing last year, this year, and next year is a period of very strong growth. And we expect this strong growth at least to be maintained in 2016, albeit at a lower pace. So this is the context in which we're operating. And what we can see there, if we look at this in a longer term perspective, is that the economy is moving back towards realizing its productive potential. So if we just take unemployment as an example, we had a peak of 15%. We now expect unemployment to move below 8% at the end of 2016. So there's a very significant reduction and an absorption of a pool of spare capacity in the economy. Nonetheless, we would say that there still remains some remaining spare capacity. So we basically, the growth rates that we are envisaging are not bringing in the economy back to its full potential. It's eliminating a lot of the gap, but not actually completely eliminating the gap. Now, this improvement in the economic environment should be more noted, really reflects two factors. One is what you might call the elastic band theory of recession. So when you have an economy that falls very sharply, there tends at some point to be a sharp pickup in recovery. And we mentioned that at various points in the Bulletin article about the pent-up demand, postponed consumption of durables and so forth, and investment as well. So that's one element. But I mean, just to look at that is misleading, because by that very logic, Greece should be expanding at a faster rate than Ireland. So it is not just the pent-up demand element. Also, it's a successful policy that has played a major role, not just in the public sector in terms of restoring the public finances, but also in the private sector where households have strengthened their balance sheets and deleveraged. The financial system has restored to a considerable extent its financial position. So all of these private and public sector actions have laid the basis for the strong growth that we are seeing in the economy. And of course, it is inevitable that the growth rates that we have seen will not be sustained in the medium term. Most estimates of available potential growth would suggest growth of the order of 3 to 4% for the Irish economy. So we should expect the economy over time, maybe beyond our forecast horizon, to converge back towards those rates of growth. Now, if I have you got the slide?
Oh, sorry. Yeah.
Turning to the fiscal policy issues, I mean, any discussion of fiscal policy has to start off by recognizing that there have been outstanding and major achievements in this regard. The fiscal deficit has been reduced from a peak of over 13% of GDP to a likely deficit of the order of 2% this year, while the debt ratio has come down from 120% of GDP plus to a likely 100% at the end of this year. So this is really a major achievement, and we should never lose sight of this important achievement. Of course, a lot of the improvement of the public finances has been attributable to policy actions over the years, but also in the more recent year, and particularly this year, the public finances are benefiting very strongly from strong economic growth, and you can see that, and I'm sure you will see it later today at the press conference on the Exchequer returns, where there's a notable outperformance relative to the profile, or there was until the late stated. Now, this favourable context provides an opportunity to achieve a faster deficit reduction and to reduce the high level of burden of debt. Why would you want to do that? Well, there are a number of considerations we should bear in mind when we talk about fiscal policy going forward. First of all, of course, we're part of the broader European policy framework. There are a set of rules in place which set out the sort of minimum requirements are what are needed. In particular, in the case of Ireland, we are now entering in 2016 the preventive arm of the Stability and Growth Pact, and that would require an adjustment, an improvement in the structural balance of the order of 0.6% of GDP next year. So we must, in a sense, abide by the rules. The second consideration, of course, is that we have seen in the past that pro-cyclical fiscal policies damage the economies, and it's very important to avoid that. So if we look at what's going on in the economy now, with a growth rate of 6%, falling unemployment, it's very evident that there is no need from a macroeconomic stabilization point of view for any fiscal stimulus in the economy. The economy, in a sense, doesn't need it. So that consideration has to be borne in mind. So we should avoid those pro-cyclical policies. And of course, the fiscal situation has improved a lot, but it is still vulnerable. We still have a deficit. We still have a debt ratio of around 100% of GDP, and that means that the fiscal situation is vulnerable to adverse shocks that can hit the economy. Remember, we're having very good growth performance now, but it will not always be so. So it might be prudent to use the opportunity to put the public finances into a position of safety. Thank you very much.
That's right. Thanks. I'll just briefly mention some articles that we have in the Bulletin on this occasion. So we release these articles during the week, so you've probably seen them, and so I'll just mention them fairly briefly. The first article looks at the financial crisis in Ireland and the impact it has on government revenues. And this paper was recently awarded the 2015 Miriam Hederman O'Brien Prize by the Foundation of Fiscal Studies and was presented at a foundation event during the week. So it looks at the evolution of tax and non-tax revenues kind of during and after the financial crisis, and what these developments essentially suggest for fiscal policy. So it shows the extent to which kind of reliance has gone back on more stable revenues, in particular income tax receipts, and also the extent to which there has been a significant rise in non-tax revenues in recent years, partly related to kind of issues to do with the financial crisis. And so I suppose the reliance on more stable revenues, given the sort of, it contrasts that with the reliance on, I suppose, what proved to be less stable revenues during the boom period. It shows that to be a more desirable situation. Second article then, just briefly, looks at the new locational banking statistics, which have been produced by the bank and which enhance the quarterly data that's there. So they incorporate a series of enhancements. These data provide information on financial assets and liabilities of banks resident in Ireland. So they now provide full balance sheet breakdown with counterparty country and sector breakdown available. They make the point that if you look at the external assets and liabilities of the sector, that they're down significantly, although it's the IFSC banks which largely account for the bulk of external positions of Irish banks. And then it also has some new information on income data, and there's an expanded income data statement which is going to be released later this month, which will flesh that out even more. So that's those are the two articles which we have in the bulletin on this occasion. So.
Okay, we'll turn to questions now, and I think, John, some of the authors of those articles are available if you have further questions on them. So if I could open the floor to questions, and you might give your name and your media outlet as well, please. Joe Brennan, Bloomberg.
Yeah, Joe Brennan, Bloomberg News. The political argument that the need for the political argument that they're still going for an expansionary budget of 1.5, 1.2, 1.5 billion. The argument has been made that that's necessary because the economy isn't running at full capacity, that unemployment is the order of 9.5%. Does that carry much water?
Sorry?
Does that carry much water, that political argument?
Well, I'm not sure that it's a political argument as such. One could make it as an economic argument in a sense. But I think there you have a situation always where you have a measure of the output gap, the level, and the rate at which it is closing. So whatever view you take, with the growth in the economy at 6% per year, more or less, the output gap is closing very fast. So basically, I don't think there is a good economic argument in terms of macroeconomic stabilization to say that you want to eliminate the output gap immediately. I mean, that may end up in a policy like that may turn out to be destabilizing rather than stabilizing. So from an economic point of view, I don't go into politics, I would say that that's not a particularly convincing argument in this context.
Fine.
The Fiscal Advisory Council have said that under the currently looking at if they went ahead with 1.2 to 1.5, we would stay within the budgetary rules of the EU. But the ESRI are saying that we should not use any expansionary budget. Would you be more or less coming down on the side of the ESRI?
Well, I would not get involved in a fighting match between the IFAC and the ESRI, but I think our position is that, the IFAC, in a way, from the public finances point of view, are the people to go to. They are the experts on fiscal policy. They have come to the conclusion, A, that it's likely to be consistent with the rules, the point number one. And the other point they have made is that it's within the margins, just about financially prudent. So that's basically the argument the IFAC has made. We would have no reason to disagree with that. Now, in terms of this issue of pro-cyclicality and stimulus, it's a very complicated issue because just measuring the fiscal stance, there are quite a range of different measures. The change in the cyclically adjusted budget balance, change in the primary adjusted balance, difference between actual outcomes compared to no policy and so forth. So it's not obviously clear that you can say the measures that were envisaged in the spring statement would necessarily constitute a pro-cyclical policy. That would depend on which particular indicator you would look at.
Vincent Bulletin, Financial Times. 1.5 billion euros in the context of a rapidly growing, almost 200 billion euro economy doesn't seem like a lot. I just wonder if you can explain what kind of damage that sort of expansion could cause.
Well, just to clarify, we're not saying that what was proposed in the spring statement would necessarily cause damage. What we're saying is that we're not getting into the details of particular numbers, 1.5, 1.2 or 900. We're basically trying to get across a message which is that the public finances are still in a vulnerable position, and therefore whatever can be done to improve that should be done. That's essentially our main point. And secondly, we have the macroeconomic stabilisation point. But we're not arguing that the measures are going to impose damage on the economy. And I agree with you. The numbers as a percentage of GDP that our people are talking about are not dramatic. And finally, as I say, when you look at this measures using standard techniques for measuring this fiscal stance, it's ambiguous whether this is an expansionary policy or a contractionary policy.
I suppose the point that is being made there is really that the high debt level leaves a vulnerability. That the debt level still remains high, and that leaves a vulnerability to an adverse growth or interest rate shock at some point in the future. The point really that sort of about making inroads, I suppose, into eliminating kind of legacy issues, because the level of the debt is a legacy issue. And I suppose a point about resilience as well, really, that it would increase resilience to future shocks.
Would you be concerned that, say, supplementary budgets, say for health budgets, could turn the 1.5 billion into an expansion plan?
I think you're addressing a very interesting point now, because a lot of the discussion, naturally enough, is about budget targets and fiscal targets and what for the year ahead. But a very important aspect, which is probably as important, is the implementation. So in recent years, implementation of budgetary policy has been very successful. The budgets have the outcomes have been more favourable than the original budget numbers, and we're seeing that particularly in this year. But it's very important in the next year that the same policy, the same tradition is carried on, that the implementation is in place, and that the targets are actually achieved in the real world. Because ultimately what matters for the economy is the outturn rather than the target.
Do you have any further questions? Yeah.
Cormac Lucy, Sunday Times and Times Ireland. Can you confirm that the central bank has played no role in the failure of the Oireachtas banking inquiry to publish the statement of Mr. Frank Brown, the former head of your Financial Stability Division?
I think that's a matter that I think we need to deal with after the press conference, if that's okay. This is purely on the quarterly bulletin. Thank you.
Just asked, two ministers in the past week have come out to argue that the central bank's mortgage rules are still too restrictive. Has there been any engagement with the government over these? Is there any prospect of them changing again?
Well, and the mortgage rules what we are doing is we are monitoring the impacts of those rules and how they are affecting the property market and the broader economy. It's very early days yet. I mean, we've really, most of the lending that took place in the first half of the year was not affected by the rules because it was approved prior to the implementation. So that's one point to bear in mind. Secondly, there are a range of indicators that we need to be examined to actually get effect. Of course, on the property market, as in other markets, we have a number of other factors affecting the market rather than just the mortgage rules as such. So basically, and the final point is, of course, we're collecting ourselves data, which will help to, and analysing that data, which will help to get an insight in how the rules are working. So our position at the moment is we are looking at this, we are monitoring carefully what is going on. Typically the results of this monitoring will be reported in our macro financial review, which is published twice a year, where we will present the various indicators that we're looking at and how they are evolving. But I think it's far too early to say, make a definitive judgment on the impacts. What I would say, there seems, putting the various pieces together, to be some evidence that the measures have affected house price dynamics, particularly in Dublin. You'll recall last year there was very strong growth. I think at some time it peaked at around 25% year on year. Since the end of the year, this has leveled off. And our own evidence on surveys of property market professionals, they have revised down their expectations for house price increases, and they cited the mortgage rules as being a factor. So there does seem to be some tentative evidence there. But at the present moment in time, we're in a state of monitoring the impacts, and there is no plan at this point in time to change in any way the rules.
Thank you. Yeah.
Just on the growth, and you make reference to the output gap and how we're closing that, or it's close to being closed. Do you see any dangers in the regional split of growth? That if there is a neutral output gap across the country, one imagines there's quite a negative output gap in Dublin and a rather large output gap in rural Ireland. And does the central bank have a view on that split?
A very good question. I mean, it mirrors in a way the discussion at the euro area level. So we have the cross-country divergence in output gaps and cyclical position. I think, yes, it's clear the fact that the recovery was primarily initially in Dublin and was working there. It seems to be spreading out throughout the country. But the case is that, Ireland is an integrated economy. We have a free labour market. We do have free movement of labour within the economy. People go from rural areas to Dublin and vice versa, free movement of goods. So I'm not sure it would make much sense to talk about, say, the output gap for Kerry. Yeah. I'm not sure it makes sense to talk about the output gap for Ireland either, but that's another issue. But so I wouldn't see that. But there are regional dispersion. There's no doubt about that in the recovery, but that I think seems to be diminishing.
Yeah, if we say, for example, if you look at the employment data, kind of which say it gives a regional breakdown, and you're correct in saying that what you would have seen initially certainly was a kind of a recovery that started in Dublin, and the improvement in the labour market has been strongest in Dublin. Now, what we've seen over, I suppose, the last year to 18 months has been that recovery broadening out regionally. So if you look at the regional data, it's now improving everywhere. Unemployment, the unemployment rates across the regions are coming down everywhere. They're still lower in Dublin than they are elsewhere, but it has been a recovery that has not just broadened out in terms of, say, moving from exports to domestic demand. It has been a recovery that's moved also from Dublin out. But the pace of it and strength of it has been strongest in Dublin, that's true.
So you want to say about doesn't make sense talking about an Irish output gap?
No, well, I wasn't saying, I was talking about a Kerry output gap. I mean, there is this debate. It's in the case of Ireland. There is a methodological debate about whether it is meaningful or easy to construct an output gap measure. One of the big issues in Ireland is that you have a relatively open labour market, so you have a lot of migration. So what is the natural level of employment in Ireland? It's because migration affects it. That's just one. So there are a lot of complexities involved in calculating an output gap for Ireland.
Take a question over here.
Just in terms of our current GDP growth, how much of it is being flattered by contract manufacturing? Do we have a calculation of that? What's happened there? If you look at the data, essentially it has netted out. So what tends to happen is that we've seen, say, an increase in exports, or say, for example, we've seen an increase in investment more easily from the activities of multinationals. But there's tended to be an offsetting increase in imports, which kind of nets it out in terms of GDP. So say, for example, if you look at when CSO published the data for 2014, initially, as you went through the year, there would have been much more activity on the export side than on the import side, but then you saw services imports increase significantly. So CSO made a point of saying that the net effect, essentially, they highlighted that the net effect on GDP kind of netted out, so it was zero in effect. It's not being flattered. No, it's not being flattered. But the issue you have to just kind of watch when you're looking at it is that if you look at the investment numbers, just headline, in there are things like, say, from the recent changes, things like the aircraft purchases and that, but they've gone up, but imports have gone up as well. So when you do it across, one's plus, one's minus, so they net out.
Any further questions? Yes, please go on.
You're saying that a lot of the reasons for the quicker than expected growth is, or one of the reasons is the easing up of consolidation and so on. You're calling for a neutral budget now. Is it not the case that if the government was to ease up a bit, have some tax cuts, spending increases, that in itself could drive consumer demand as expected and boost the economy further? Is there not an argument, therefore, for doing that when you're saying that there's no need for it, but perhaps it will spur growth on further if there was?
In terms of, sorry, I was just thinking about the last point there.
I mean, in terms of the impact of it, I mean, it probably will have, I suppose it will have some, yeah.
But I think the idea, just to clarify, I mean, of course, in any state of the business cycle, even in a booming economy, if the government does a fiscal expansion, it may add more growth to the economy. But the problem there is you're destabilizing the economy. You're adding fuel to the fire, in a sense, when the economy is burning hot. And the result of that is that your fiscal position is less strong. So when the economy maybe has a weak time period patch, and when you want to do fiscal stimulus, you're not in a position to do it because you're running into fiscal rules, or there's worries about the solvency of the government. So the idea then is, if you have a counter-cyclical fiscal policy, you tighten when things are booming, you ease up when there's a recession, that will stabilize the economy. So what you're suggesting more in the sense is a pro-cyclical policy which adds fuel to the fire.
Any final questions, Joe?
Just in terms of wage inflation or compensation inflation, do you see that picking up marginally in the next few years? Do you see that kind of accelerating post-2016 as unemployment continues to kind of fall?
I mean, what's happened, there hasn't been much movement in that for quite a while. So kind of what we've seen sort of over the last year or so has been kind of some increase in it, but at kind of relatively modest levels. And what we forecast kind of over the horizon is kind of some further increase in it, just at 2% or so, a little above 2%. I mean, it's concentrated in private sector, and at this point, it's not something that we'd be. It's kind of natural given the state of the economy, and it's not something that we'd be particularly worried about.
Do you have any final questions? If not, okay, thank you very much for coming, and we'll see you again at the next bulletin.